Hello, and welcome to today's panel. I'm Joe Chidley, Managing Editor of Canadian Family Offices, and it's my pleasure to be moderating today's discussion, which features four experts in the area of alternative investments who collectively bring a broad and deep knowledge of the subject to the table. Before we get to introductions, one housekeeping note for the audience. At the bottom right-hand corner of your screen, you should see a help button. If you encounter any difficulties during the presentation today, just click on help and you'll get some assistance promptly. Okay, on to our topic. It's a big one, alternative investments. As you know, alternatives comprise a big, wide, and heterogeneous universe, from private equity to farmland and just about everything in between. I think there are a few bottles of wine in there as well. There are, in short, far more corners of this universe and maybe a few black holes than we can get to in 1 hour, but hopefully we can explore some of the more interesting opportunities in this vast field, and in particular, the way that alternatives factor into the portfolio mix of family offices. To help guide us on that journey, our four panelists today have graciously agreed to share their wisdom. Thank you, gentlemen. I will let you introduce yourselves in turn. Dale, do you want to kick things off?
Sure. Thanks, Joe. And hello, everybody. I'm Dale Powell. I lead the investments business for Citi Private Bank in Canada. I've been at Citi for nearly 13 years. I've done investments for, we'll call it 30. I prefer to call it 30 years. It's longer than that, but we'll round it to 30. I lead investment counselors in all of Toronto, Montreal, Vancouver, and New York. I've played a part in raising about $1 billion in alternative investments for the bank over the time that I've been here. I'm a CFA charter holder and a past board member of the Toronto CFA Society.
Okay, thanks, Dale. Great to have you here. Robin.
Good afternoon, everyone. My name is Robin Tessier. I'm a partner and the head of products and solutions at Sagard. Sagard is a Canada-based global alternative asset manager. We manage about $30 billion, mainly in the four buckets of venture capital, private equity, private credit, and real estate. Before joining Sagard about three and a half years ago, I was a managing director at BMO Capital Markets. Before that, CIBC Capital Markets, and I was a corporate lawyer before that, also a CFA charter holder like Dale. Pleased to be here today.
Great. Thanks, Robin. Corporate lawyer on the panel. That's always good to have.
We're recording this.
Yeah, okay. Next up, Christopher.
Yeah, hi everybody. I'm Chris Foster. I'm the CEO of the Foster Family Office Group. But before taking on that role, I was working pretty exclusively in the alternative space. My first job, funnily enough, on Bay Street was with Freeburg Mercantile Group. I don't know if you guys recognize that name, but they were actually sort of pioneers in the alternative space. They launched what I think is Canada's first real global macro hedge fund in the very early 90s. After doing that, I was running a big futures team at Scotia, serving a whole bunch of alternative investment managers. Then I went on to run my own asset management firm, running alternative investment strategies in options arbitrage, global macro. And so when the opportunity came up to take over my family's wealth management practice, I saw it as a great opportunity to bring alternatives into the wealth channel. At the time, there was a lot of trepidation about alternatives back in 2017, and there was certainly not a lot of experience with alternatives inside the wealth channel. So anyway, that's what I did. I brought in a whole big slate of alternatives and married it to our family office group. And we've been running low volatility portfolios ever since.
Okay, great. Thanks, Chris. It's great to have someone at a family office bringing the perspective on alternatives, because we'll get into that in our discussion today for sure. Dan Riverso.
Hello, everybody. Thank you very much for attending today. My name is Dan Riverso. I've been in the family office space for 20 years or so, and I'm currently CEO and CIO of Jesselton Capital Management, which provides bespoke fund services for family offices. Prior to that, I ran a family office here based in Toronto called Continuum Private Wealth Partners. And prior to that, I was at i3 Advisors, where I was director of research. And throughout that time, I've been covering alternatives across the different buckets, everything from hedge funds to private debt to farmland to music royalties. So quite a bit of experience in the space.
Okay, terrific. Well, this is a stellar group of individuals to talk about alternative investments today. And I will tell you that within the editorial halls of Canadian family offices, we always have some debate over what qualifies as an alternative and what does not. So I'm going to start you off with a very simple question. Jump in as you see fit. What is an alternative investment exactly? What is
Uh,
one? What
uh,
isn't one? What do people think is an alternative that isn't, etc.?
Yeah, I mean, look, I'll take that one, Joe.
Okay. You're a brave man.
Stepping into the lion's den. Yeah, look, I wish I could give you a great answer on that. Alternatives is kind of like other amorphous kind of expressions like hedge funds or family office. But by the way we think of it at our shop, it's a definition of exclusion. That is, if it's not an equity, it's not fixed income, if it's not structured product, if it's not a money market instrument, then it's probably going to be an alternative.
Okay.
I would agree with Chris's comments. Generally, I look at it as anything that's not traditional stocks and bonds.
I would
Yeah,
agree with you. Oh, sorry, go ahead, Dale.
sorry, Rob. I was going to say almost exactly the same as Dan. An alternative for us, anything that's not publicly traded, but if it's not not a long only stocks, not only long only bonds, maybe not a cash instrument, it's probably alternative.
I would, of course, agree with my co-panelists. I would probably also add that I think it's becoming a much richer investment universe. I mean, I think, Chris, you mentioned that the definition arises by exclusion, right? I mean, it's alternative. Therefore, it's not the two big buckets, stocks and bonds, which candidly is because, at least on the equities, we're seeing it's becoming a smaller investment universe with, a shortage of, new issues and IPOs and just more private companies than public companies. So I think some of the other more niche asset classes that some of the gentlemen listed are certainly valid. I would also say, I mean, at Sagard, I think we consider ourselves an alternative manager, but within alts, we're private. So it's a even smaller box. So we don't do hedge funds, so of course you can get into liquid alts. So for us, we're more private focused than alternative, but I think it's a much richer investment universe that it has been historically.
Right. Okay. Good point. So, and here's another, perhaps, I actually you've answered that very well. So this is not another unanswerable question, but it may be unanswerable. What's your sense, in a very general way, of how alternatives are faring these days? There's been a lot of, obviously, attention paid to volatility or chaos in public markets, and on the macroeconomic landscape. What's your sense of how alternatives are faring? And I know it's general.
I'll take that because
Yeah.
I think that's kind of like saying how are stocks doing. I don't know because I don't have the market. I've got a portfolio of different things. Some are going well, some are not. So I think it depends. Like anything else, depends on the selection that you make. There is no broad measure of how it's doing as an asset class. So it depends entirely on the product. I don't know what my colleagues think, but that's the way I view it.
I would generally agree with Dale, but I would say that the rapid rise in rates has really impacted hedge fund returns. I mean, again, it depends on the strategy as well, and certainly not just hedge funds across some of the other alternative investments, but definitely some have held in, but others have not done so well.
Mm-hmm.
Yeah, look, our experience has been that, whereas 2022 was a pretty great year for alternatives, despite stocks and bonds both sliding considerably. I think that was largely because private equity was holding up pretty well. And I think for most alts allocations, private equity is a decent sized sleeve. This year, unfortunately, private equity has been soft during this period of market volatility. So we're actually finding that our alts bucket as a whole is a little softer this year versus, during what was really a calamitous year in 2022. So, yeah.
Yeah. Go ahead.
Go ahead.
Sorry.
No, go ahead, Joe.
No, I was just going to dig down a little further into private equity, because that is one of the more discussed areas of alternatives, I think. And there's been some, coverage this year about, challenges to capital formation, the IPO pipeline drying up. Do you have any thoughts on where private equity is now and where it's headed this year? And again, big area.
Well, I'll maybe offer some thoughts on that. And we have
Yep.
Sagard manages, private equity. We have fund of funds, we have a European, we have Canadian business. So we have a pretty unique lens into this. But your points on the capital markets and the effect of capital markets is certainly a valid one. As you may know that, in private equity, you're buying a company, you're hoping to improve it, change the capital structure, improve management, and then ultimately sell it at some later point in time, TBD. And a big reason for the TBD is the availability of liquidity options. Those could be, another strategic buyer, another PE firm, and of course, the public markets. And we sometimes joke around here that there's this state of what we call constipation in the public markets. It's just there's not the ability to recycle and turn the capital, right? Which forces some of the managers to become a lot more creative about creating liquidity, right, for underlying holdings or portfolio companies. So that's something that we keep a very close eye on. Obviously, it's something we can't control, certainly the public markets, but I think that's something that is a really big factor over the private equity.
And just to add to Robin's points, I think it also lends to the growth in the secondaries market as well.
Can you explain that a little bit, Dan?
Generally, I think given the structure of the private equity market and sort of where we are in the cycle, a lot of GPs are looking to potentially get out of certain investments, and they're using the secondary market to do so. So spreads, I believe, have gotten tighter over time, but again, lots of growth in that area.
Okay.
I agree with you, Dan. We've seen that on the products that we can bring out to our clients. I would say on how do we see the sector looking forward, I think the biggest factor for the way we look at it is the rise in interest rates. To be blunt, it's not that difficult to be pretty good at stuff with free money. When money is no longer free, the cream will rise to the top. And I'll say, for all my colleagues, all fit into this category. The cream will rise to the top. People who know what they're doing will do fine. And as was mentioned earlier, you'll get creative and you'll find other solutions for temporary market situations. But good managers will continue to do well. And that's probably a positive development for the sector overall. Improve the quality that we're offering. Okay.
Okay. Do tariffs and the sort of macro landscape factor into this as well? I mean, Dan mentioned rates, and you mentioned rates too, Dale. And I know rates are related to the macro outlook, obviously. How much is this just the uncertainty sort of rocked private equity deal making and other alternatives areas as well?
I think it has to be very large, Joe. The Trump administration is a chaos vortex, and it's very hard to plan and value a company under those circumstances. Rates have been coming down. That's helpful. But I think until we get some level of macro certainty, I think the deal pipeline is going to remain slow.
Okay. Any other thoughts on that? Anyone want to wade in that vortex?
I maybe have a slightly different view, I guess. Listen, we tell our clients, we don't manage product, we distribute product of managers to our clients. And so frankly, we tell our clients, this is a 10-year investment. It's probably 12. It could be longer than that. What happens today or next week is really not relevant to the discussion. So yes, it causes some short-term stuff, but for the validity of the investment and the reason that a family office would make the investment, tariffs or whatever is in the headlines, we're investing for 10 years or 12 years down the road, not next week.
Okay.
I would agree with Dale's comment. I just think really piggybacking on Chris's, though, I think just the tariffs and the uncertainty, whether it's created by rates or tariff policy affecting the public, it affects the private market too. It's not like we're entirely divorced from the public market. So, the private markets or the alts, they may not be as subject to the up and down mania of the public markets, which we've seen in equities over the past really couple of weeks, which is shocking. It still affects tone, right? It affects tone, deal making, financing, even investment. And I agree, Dale. I'm sure he's very successful about convincing his clients to look past this period, which we all should be lucky to do. But it's not the easiest thing to do, right? I mean, we're all in seats where we try to do that, but there's always a client on the other side, and it just does slow and dampen things. I don't think
it causes overarching everything, Robin, as you're saying, it's uncertainty, right? So yes, it's easy to say you're doing a 10 or 12-year investment, and you are, and that's true. But we are all living in a period where who knows what you're doing. And if you're dealing with entrepreneurs, as I'm sure all of us do, and we do, hey, listen, they're worried about their business. How do you make a sensible business decision aside from what you're investing outside? So I don't want to minimize it, but that's, we try and get around it as I said, this is a long-term investment.
Okay. I mean, one of the reasons to get exposures to alternatives in the first place is because of the non-correlation to traditional publicly traded securities. Is your sense that, I mean, the past few months would certainly be a test case for that proposition, right? In terms of volatility, is your sense that alternatives are fulfilling that function well now during this chaos?
I'll volunteer a thought. I would say so generally. I would say generally yes, in the sense that, when I think about it, the pools of, I'll say, private capital, they are of course valued, and they move in their marks. But I think, the reason that actually is a bit delayed is because there is a lagging effect to the valuation and the marks, right? Whether it's a single portfolio or asset or fund of funds. I'm not saying that's perfect, and I'm not saying there can't be marks up or down. It's just a lagging effect. So the other point too, and I highlighted it, when there's not another vehicle or pool on top of it, which has smaller liquidity, that's when it's one thing to throw a rock in the lake, but when you throw a rock in your bathtub, it really has an effect, right? So when you shrink the pool of liquidity, any if it were the 5 or 6, but any decision is going to disproportionately impact everyone else, and so you get my exit creates a mark on everyone else, and that is something that's not as appealing when everyone else wants to continue in the investment. So I think that volatility. I mean, I know people always, it's almost a motherhood statement. They like low vol. I think they like it when other things are falling. But hey, if you've got beta and the market's ripping 25%, it's nice to go on that roller coaster too. So I understand why people say that, but I think they always have it with a view with downside as opposed to upside. So again, I'm not naive about it. So I think it's generally provided that it's a less amplitude. It's buffered things a little bit, but over the long term, like private equity is generally outperformed public. So is that probably with lower volatility though. So
okay. Any other thoughts on that? Thanks, Rob.
I'll just maybe speak to the hedge fund side. I think that, generally with the volatility, it creates opportunities for a lot of these hedge funds. And I think some of them have done quite well given the volatility that's now presented. When the market's racing higher, there's not much in the way of volatility. They've lagged, but the current environment gives them a bit more opportunity to contribute and produce alpha.
Okay. So are there areas, so we started with like, what is an alternative? And it's a lot of things defined by, negatively defined in terms of, they are what they are not. Are there areas within alternatives, again, we can get back to private equity or harder assets, that you think hold particular potential right now that you're looking at and going, yeah, that's a potential winner?
I'll take that, Joe. One of our most interesting allocations right now is microcap in Canada. We sort of think there's an opportunity for a big revaluation in Canada. We've been through a lot, clearly. Valuations are compressed. And I think there's a chance that, the Carney administration actually liberalizes the Canadian economy, gives us a little bit more entrepreneurship. And so we think particularly small cap in Canada is going to do very, very well if we can escape this chaos. So we actually have an allocation to a little microcap fund called Tessier, very, very small. but very, very small companies that they invest in, and they are just so cheap. So I think if the clouds can part in Canada, I think small cap Canada is going to do very well.
Interesting. Any others? Any other thoughts on areas that are looking good to you?
We don't do Canadian product for our clients, Joe. So everything we do is on a global basis. And so I'll leave it there. Everything we do is global, and we try and do something thematic. What you likely wouldn't see us bringing to our clients is we're some tiny sliver of a $25 billion fund that some mega manager is offering out, because our clients don't need us for that, and they can get that on their own if they needed to.
Right, yeah. So because your outlook is global, are other geographies that you're particularly interested in now, or does that factor into the way you look at things?
Well, we've been doing more Europe over the last year or so, but that's simply because it's cheaper. Most of the private equity market is, and probably for most of the future, will remain in the United States, but we've just been looking at it to non-US managers. Frankly, just it's cheaper, and it's a diversification play. None of our clients are short of US exposure.
Right. Okay. So on the flip side of the opportunities question, are there areas that you think are particularly risky right now within alternatives? And what are they?
I mean, I'll take that one as well, Joe. I'm very worried about private REITs. The marks that a lot of these private REITs have in the apartment and multifamily space, I don't want to say they're a complete fabrication, but they're possibly aspirational. I think the private REITs are marked down pretty dramatically. You guys probably know that, down 15, 20%. Rents are soft. Values of buildings are theoretically soft. But these private REITs keep on holding their NAVs. They have billions and billions and billions of dollars in AUA. And I fear that they have been sold to relatively unsophisticated investors. So I'm concerned that if somebody sort of yells fire in that crowded theater, that things could get bad. So I would keep a distance from that particular sector, the private REIT sector, for sure.
Okay.
Sure, I'll jump in and maybe dovetail with Chris's comment. The private debt sector. I mean, there's been a global substantial rise in debt. A lot of it is tied to real estate. But I'll also echo what Dale had said earlier. I think, if you're looking in that space, want to reduce your risk. It really comes down to the manager. You want somebody with good pedigree, good process, because there are a lot of funds out there that, again, to Chris's points, might get sort of tied up if something starts to happen.
And truly understands what they're buying, Dan, right? So,
yeah.
And I would echo what my colleagues are saying. What worries me, private credit, private debt, call it whatever you like.
Well, I'll even offer a thought there, just because we have a private credit strategy, and I appreciate the comments. And I agree with them to a point, only in the sense that we would deliberately call ourselves a mid-market manager, right? So and non-sponsor. I think this is a difference that I think is kind of unique in the sense that, again, having worked at capital markets, a lot of the banks are really following the financial sponsors, right? And so they're effectively deal takers for a lot of these credits. They get a term sheet on Monday, there's a bid on Friday, there's not as much diligence, not as much covenants. I just say, with respect, our process is very different. We're dealing with companies, founders, families where, we have extremely tight covenants. Our terms of leverage are, 3.5. LTV is like 30%. So I certainly appreciate those points. We focus on a much less competitive part of the market, right? It's more mid-market. And so we believe when we're at the top of the capital stack with those protections and with those levels of leverage, we're feeling pretty positive about it. But certainly appreciate the comments at different segments of the market, because we see it. We see some of the big guys knocking around in the same deals, and we see them above us, and we just let the collisions happen to some degree. But I think we're all keeping an eye on it for sure.
And that goes to the comment I made a few minutes ago, Robin. I think good managers, and you are obviously you
Yeah.
are good managers who know what they're doing and have a process and understand what they're buying. They'll be fine. It's not on a specific side. I think it's more on a general side. I think Chris, you said some of this stuff has been sold to relatively unsophisticated investors who probably just put out a glossy book with a yield number on it. Hey, that looks pretty good, but haven't done the diligence beyond that. And so if you do the diligence and you know what you're buying, I agree. I think you're probably fine.
I think some of it too. I heard our CEO Paul Demery III, like literally this morning, commenting on this, because I mean our firm. I should have mentioned it. We're more of an institutional shop. Like, so our clients are generally pension funds, life insurance, endowments. So we come at it from an institutional caliber pedigree. I think some of the. I mean, I think I know what some of my co-panelists are referring to. There's been a few managers in the market where, they haven't built it that way. They're not very diversified, and doing things like payment in kind or PIK, like that, like that's just stuff we don't ever get involved in. And so when you see that, those to us are big. I think the biggest discipline of a credit fund is when you keep getting paid every month or every quarter when you're supposed to, like that cash flow, that tells you that something is at least working, right? And in our business where things don't, the covenants are so tight. I liken it to like driving down, the Gardner here in Toronto, either the 4 or 5 lanes. If you're not in one tight lane, things can, by the time you hit that guardrail, things can be going really wrong. Whereas our business, as soon as you get out of it, it's like your car, it shocks you, right? You're out of your lane, zap. You're talking to us again. We're at the table. There's maybe a penalty for a minor breach. Like that's how, when things go wrong, we are right on top of them, so we can be there to help correct the business. So it's a very different approach. It's very concentrated. It takes a lot of work, but I think it generally works for us.
Okay. Yeah, that's a theme that's emerging, right? So much like it's less about the area of the alternatives universe than the quality of the management, right? And do they know what they're talking about, and do they have those strict governance rules as well? Which leads into the next area I kind of want to explore, which is how family offices are approaching alternatives. There's been a lot of research into family offices, including one of our own surveys last year on multifamily offices, that has pointed to a large and growing interest in alternatives as a space, particularly private equity and private debt. Is this your experience as well? And if it is, what's driving that interest?
I'll jump in for that one. I would say that generally a lot of the family offices in Canada, the majority of their allocation is to private equity and real estate as well. I think that's just a function of sort of the evolution of family offices. If they sell off their operating company of capital, they tend to dive back into things that they generally know, and that leads to private equity and real estate. A lot of it is direct deals, but I think they are looking to do some funds in certain cases.
Is that the experience of the rest of the group as well? Chris, you bring a certain perspective to this.
Yeah. Look, I wouldn't say that clients are beating down our doors asking for alternatives. I would say rather that people are getting, wealthy families in particular, are getting really tired of white knuckling it through all of these big fluctuations in the market. It's bad for your health. It's bad for your cortisol levels to have to endure that. And if you can show them that alternatives can actually moderate their volatility and allow them to sort of go to sleep on their investments again, that is very, very welcome. I keep on telling our advisors and our portfolio managers that volatility is bad for families, right? It's not just bad for your stress level. Your portfolio is down 20%. The whole family is in a whole pile of hurt. People are blaming each other. Who's driving this ship? How did this happen? Blame game starts. So it's a very unhealthy thing, not just for your health, for your family. So I think that's the big driver, getting away from the white knuckling.
Do you think the current market conditions, there's a lot of white knuckles out there right now, does that make it a potentially good time to think about alternatives if you haven't thought about it before?
100%.
Okay.
And I would say some family offices are looking more at alternatives, whereas they were more traditional. or private equity real estate. They're now expanding beyond that.
Okay. All right.
Not in the allocation biz like my friends here, but I don't know how the past few months cannot at least nudge you in that direction. Like I like Chris's comment about white knuckles. I don't know how it can't be helpful, or at least because again, it snapped back so much. It's like, hey, it may not have snapped back. So how about we all learn a lesson here, right? So for the allocators and the wealth side, I think it's auspicious.
So sorry, go ahead.
Sorry, Joe, I was going to say for our clients, I'm trying to think of it. I don't think I have any clients who don't have alternatives in their portfolio. We take an asset allocation approach with all of our clients, including family offices, by the way. So for us, here you go. You have an allocation to public equity. You just should. You've got some fixed income, might have some cash. You've got some private equity. You've got some real estate. You've got some hedge funds. You just always do. So what's happening in the market just doesn't particularly matter because you have that permanent allocation. I would share that view with the rest of my colleagues. Does it provide some buffer to the white knuckles? Sure, absolutely it does. I would suggest in a lot of those cases, it's a little bit convenience with not mark to market, but that's okay. So our clients are always interested in alternatives. They just always are. It's a key part of our business.
Right. So how does it, you mentioned asset allocation, Dale, how does alternatives in a portfolio change the asset allocation mix? Like if we take the traditional 60-40 as a baseline, where do alternatives fit into that? Well,
we don't have what I call, be careful who's on the call. I don't call them happy meal. We don't have what I call happy meals, which is, there's your 60-40. So you got a 20. No, we're different. We do very different stuff. Okay, so you got 20-80, a 40-60, a 50-50, and whatever, and there's your happy meal. Can I get some different? Well, no, we can't. We don't have any happy meals. Everything's custom. But a standard go-to portfolio for a family office client or for just an ultra high net worth client is off the shelf would be something like 20% private equity, 10% real estate, and at least 10% and probably closer to 15 on hedge funds these days. So it's not that would be usual for us, and it's not at all uncommon to have 50% of a portfolio in alternatives for us.
Yeah, we're at almost exactly the same place, Dale. Our alternative sleeve is about 45%, but then we also have a non-confiscatable asset sleeve, which is like gold and Bitcoin, and that's like 5%. So we're pretty much spot on 50 if you include a broader definition of alternatives. And that seems to work pretty well to get sort of the beta of our client portfolios down to sort of half market levels, which we find is where clients really want to be. Market's down 20, they're down 8, everything's great.
Yep.
So
public markets for us, frankly, have just become the liquidity bucket. Right. For clients. That's where they are. And I sort of hate to say, because I made my life in public markets, but that's what they've become. I mean, I've said the story a million times to clients. When I get into this business, you're an entrepreneur, you start a business, how do you monetize it? You take it public. I think that's finished. I think what we've ended up in Canada is a lot of companies that are public that probably shouldn't be. They're probably better in a private equity structure where they don't have the same pressure that sort of we're talking about. You got a quarterly earnings and you manage the business to what analysts think you should be doing, and that's not what they want to do. So it's for me anyway, it's led to the rise of private equity and non-public markets. And so we just view that the traditional market piece, that's your liquidity bucket. That's where you can fund anything else and fund your lifestyle. And exactly as you say, Chris, public market is down 20 and you're down 8. That's a good result.
Dan, you're nodding your head there.
I just agreeing with what Dale said. For the most part, is that fixed income and public equities have become the liquidity buckets, and alternatives, you can move a bit more illiquid, and how that shapes out, whether it's private equity, real estate, or whatnot, you can start accessing those asset classes and taking that risk, especially if you have a long-term time horizon. You're able to reduce the liquidity in your portfolio.
Okay. Are you noticing any differences or changes in how family offices are investing in alternatives? Um, is there a lot of direct investment, a lot more use of funds, secondaries you mentioned before, Dan? Um, is that evolving?
I would say that most of them, I mean, this is a very general comment, but across family offices, uh, the majority of the allocation is in private equity and real estate.
Hmm.
So diversifying beyond those two, I think, is occurring, but it's a bit of a slow process as well.
I think even on Dan's point too, Joe, I think, the rise of secondaries really, given our earlier comments about the lack of liquidity events like IPOs, new issues, et cetera, that's really driven the rise of secondaries to some degree, both driven by the GP, like the manager, or the LPs, which is the investors. And so, again, not being an allocator, you still see that, like, it's harder probably for someone to say, I'm gonna sign up for a 7, 10, 12 year LP. You have a J curve while the fund gets invested, and then you start harvesting. So, as the money keeps coming back, that can be a long and bumpy ride. Whereas on the secondaries, if you come in later in the tail, you provide liquidity. Like, I buy some or Dan buys some from me. I've held this for 8 years. I'm not taking the last dollar or nickel off the table. Where his clients come in, he probably demands a bit of a discount to provide me with liquidity. But when his clients take it, they're marked back up. So I suffer a little bit, but I've hopefully made a good profit over my holding period, where he steps in now, gives me liquidity, and he still hopes to make maybe not as much as I've made, but maybe hopefully the IRR could still be quite attractive, right? And so it's a kind of a win-win for both our clients or our as principals. That's how that's happened a lot.
And to Robin's point about liquidity and secondaries, if you are worried about locking up for a long time, secondaries is a good way to access some private equity without locking up for an extended period of time.
Yeah, Dale, I agree with your point about families being willing to get into slightly more exotic strategies than really private equity and private debt. They're sort of inching out into the exotic a little bit. And one of the things that I've noticed is that pricing has really improved. Sort of gone are the days when if you invested in something that was the tiniest bit exotic, you just weren't going to get any pricing on it. And you put it with your dealer and it was just going to go right to zero because nobody was populating any pricing on it. GPs, manufacturers are getting much better at providing pricing on these products. So it makes it so much easier for people to hold these things. It's not just a big mystery when they go to reallocate or rebalance what the value is of that security. So that's really been a big improvement over the last few years, in my opinion.
And that comes with mass adoption of a lot of these strategies, even at the retail level.
Right.
There's a number of private equity strategies, and we can debate the merits of those, but more adoption leads to more liquidity.
Just a maturing of the market, right? As it becomes more stable and more developed, you'll get exactly these things that everybody's talking about.
Okay. Is your sense that is your sense, this is a very Canadian question, is your sense that Canadian family offices are leading the way when it comes to alternatives and maybe even innovation in alternatives, or are they playing catch up with the rest of the world?
I would say we're playing catch up. I was actually speaking to a hedge fund yesterday, and they thought we were sort of 5 years behind our American brethren.
In what way were we behind? Did he elaborate on that?
Just adoption of more esoteric type strategies outside or alternative outside of traditional.
Well, in defense of Canada, I will say, Canada, obviously, our product shelf is much smaller here in Canada, for sure. But, cannabis stocks, I know that didn't end up going particularly well, but we were early to market with that. And we were definitely early to market with cryptocurrencies in fund structures. We were allowing spot crypto into funds, and then we were before the Americans in spot crypto and ETFs. So, occasionally we get a win.
Definitely.
Okay. Can we talk a little bit about the best practices for family offices when they're managing opportunities and alternatives. Like what, maybe we can start with Chris. Like, what is your process for pick a part of the universe for managing that, for managing the managers, and so on. Can you walk us through that a little bit?
Well, the process is, it's not just an onboarding process, it's a constant review process for sure. One of the things that sort of makes our firm a little bit different is that we put a big emphasis on qualitative due diligence. It's very easy to do quantitative due diligence once you have a track record that you can evaluate. But, quantitative stuff is always backward looking, first off. And the qualitative stuff to me is much more important. Understanding exactly how a firm deals with conflicts of interest, it gives you a window into how seriously they take their fiduciary duty. Firms that are absolutely fierce on conflicts, I just love it because that they consider managing other people's money sort of a priestly responsibility. We always do site visits, for example. We always go in and we always see the people. We look them in the eye. We see who's working in the office. That's really important. Yeah, it's really vital, I think. And if you know somebody, for example, say you're allocating to a new fund, find out who worked there. There's somebody that who used to work there. Take them for lunch. There's stuff that people will tell you over a drink or over a lunch table they would never put in an email. So that kind of qualitative research, I think, is really, really important. You can analyze their track record all you want, but if they're dishonest, it's not going to show up in their track record. So I think that kind of stuff is really key.
I would agree with all that, and just add on under both, I guess, qualitative and quantitative, doing your operational due diligence as well, especially if the investment utilizes leverage. Talk to the service providers. There's just layers and layers of due diligence that needs to be completed and to ensure you're comfortable with the investment.
Right.
And so we have a team of people in offices around the world, as a matter of fact, for Citi, that do this on behalf of our clients. And so they're doing exactly what you guys are speaking about. And listen, I can hire an intern with better Excel skills than me to go through performance. Anybody can do that. It's the operational due diligence, as you're saying, Dan, and the other things, Chris, that you're speaking about on the due diligence front. It's critically important, frankly, for most of the family offices or the ultra high net worth investors that we deal with. First of all, they don't have that access themselves. We can get it. Second of all, they just don't have the resources to do it themselves either. And so for a manager to make it through our screening process before we'll offer something out to our clients, it's typically 6 to 9 months worth of due diligence work. And I'm told it's very intrusive. And that's a good thing because you have to do it. It's not because we're nosy. It's because you have to know that thing. Exactly as you're saying, Chris. It's not the run-of-the-mill stuff that's going to get you into trouble. And frankly, most of the time, a huge majority of the time, it's not something nefarious that's going on. It's simply, there isn't a business process around these things that say, yeah, you take being a steward of your client's money seriously, and here's how we can prove it. And for us, it's that due diligence is critical. And frankly, if we've done 5 versions of a fund with a manager and they come to us with fund number 6, they go through the same process. They go through the same process for fund 6 as they did for the previous 5. So I think that's the critical piece in all this.
Robin, any thoughts on that from your side?
Yeah, I was just thinking about I've been on the capital markets. I've been on the underwriting, so I've done the rubber glove diligence, and I totally get it with my co-pan on the receiving end though. Now I think it's interesting because listen, our process is very institutional. So I think Dale's comment about 6 to 9 months, I'm nodding because that's exactly what we're dealing with. Right, we're dealing with institutions where it's very extensive diligence, right? Data room, you name it, site, everything that I think Dale was saying. We're already used to it. And candidly, when you're speaking to an institution or they can deploy a whole team to do this, it's obviously harder the smaller the firm. And so part of it too is, as I say, it's hard to do this, but what I would, or what one should aspire to is, again, I think Chris used the term priestly. It's sort of a calling, but you want the allocators, your partners, to have trust. We all realize that it's still a risk business, right? Like things can not happen the way we all plan. Like I think we all know that. This is not GIC land, but I think whether things transpire the way one expected or we expected or not, you want to have trust that your manager is working and is transparent with you and is doing what they can to, optimize returns, get you information for your client. Like, and that for us, that's all we want. It's like, hey, talk to the top of the house. Like, come away. If you do nothing, please come away with trust that, this firm and these partners will be good stewards of your capital. And a good way to do that is, candidly, a lot of times is when they're invested, the principals, the PMs, they're invested in the same strategies, in many times on a levered basis. Like, I mean, nothing focuses your attention like a levered return that you're responsible for, and you have a lot or most of your net worth on. And I'm not, that's probably the biggest alignment point, my friends could ask about, right? And so for us, that's just table stakes, right? And again, I know I can't say everyone can do that, but I'm not saying that guarantees it, but at least you know that people are trying to do the right thing in the same way they are for your clients.
That's a great point.
Yeah, and Robin touched upon something, and that's transparency. Getting transparency from a manager, and it helps to build the trust, especially when things are not going well. If the manager is communicating, that there's some quality there.
Okay. So we're in the realm now of risk management. So what are the risks in alternatives that investors in traditional securities might not face?
I think the biggest and most, I think is the most obvious as a manufacturer is just liquidity, right? I mean, it's not stocks and bonds, it's not 60-40, it's not plus one or two. So liquidity. I think candidly though, this audience, the clients of this audience are probably do not need that as much as most. Listen, but on the other hand, like, I'm human, I'm an investor. I like to be able to see my assets and my banking and know that I could access them if I want, or value my house. But it's a bit trite, but you never need it. Or most of these clients, I suspect, do not need it as much as they would like. And so I think that is the biggest risk, but I don't think it's necessarily, I think it's just something that, my colleagues would have to make sure that, and us, candidly, we have to do this too, that they understand the price of the goal of this excess return, right? You're compounding for ideally a longer period on the assumption and goal that you will be better off over time than being in a more liquid vehicle. And again, I think our friends have said this, it's not everything. I think Dale was saying it's half the portfolio. So I think as long as you can manage that and almost come up with a liquidity ladder or liquidity needs, like you can all do that for your clients on a singular standalone basis. I would say candidly, sometimes the product itself has its own liquidity sleeve or basket. So sometimes you need it, sometimes you don't, because if you bought it as a single solution, it hopefully probably has some of that in there. But if you're building a portfolio as the gentleman here would, they're going to have to manage that on their own or within the portfolio. That's what I would say.
Yeah, I agree, Robin, that liquidity is something that our investors typically don't need that badly. So how material a risk is it? But I would say gating is a much more material risk. Like that's illiquidity in extremis, like that is the kind of illiquidity you never really want to have happen. I would personally give up 100 basis points of return if I could actually be guaranteed that I would never be gated. Being gated in a fund is death. It is the worst thing that can happen because first off, you can't actually value the security accurately. So you don't know how to rebalance or reallocate. That's a problem. And it's all your investors want to talk about is that one security, even if it's a de minimis part of their portfolio, it's a red herring in the portfolio. It's all they want to know about. So from a relationship management point of view, it's absolutely toxic. So yeah, really bad.
Okay, Dale.
I would agree with with what both Robin and Chris are saying. The biggest risk, I think, is liquidity. And Robin, I think you're exactly right. Most clients don't really need the liquidity that they think they do. I put it kind of a slightly different way. If you told a client, listen, this is a 10-year fund and it's dragged into year 14. Yeah, but it's doing fine and it's doing what they wanted. But you kind of position as 10. And now it's longer than I thought. That to me is the bigger risk on the liquidity side, because you exactly as you and Chris are both suggesting, you manage the actual day-to-day cash needs out of the other side of the portfolio, not out of the alternative side. And Chris, you're exactly right. A gating on a hedge, it's a killer. It's a killer. That's an account closing. That's an account closing event.
Okay. I think we've covered off risk mitigation and risk management through the due diligence discussion, which was great, by the way. Thanks, guys. Can we talk about crypto for a minute as an alternative investment? It seems to be doing pretty well these days, I think in part because of the congenial environment that's receiving lately in the States. Any thoughts on crypto? I mean, our research has shown, and I think some others too, that family offices are pretty reluctant to embrace cryptocurrency. Should they be changing their minds?
I'll take that, Joe. I mean,
Oh, Chris.
I find that we have a small allocation to Bitcoin, and I thought that clients would query it a lot more than they have. So I'm not actually detecting a high degree of reluctance. But crypto is a very broad moniker. It involves both the industry and the coins. And I have no view on the industry writ large. And I don't think any of the coins, apart from Bitcoin, are actually going to show themselves to be a decent store of value. But Bitcoin itself, I think, is proving itself to be a very strong competitor to gold. So, as a non-confiscatable asset. So if you can imagine having gold in a long-term portfolio, then I think you should equally imagine having some Bitcoin. It's one of the only cryptocurrencies that's actually limited in the amount of supply that can be created. And it's grossly outperformed and it's got the longest track record. So that's the only one that I would actually consider as a long-term investment. But I'm finding clients are getting more receptive to it.
Anyone else have a thought?
Maybe I'll take a bit of the other side.
Yeah.
I mean, crypto is generally highly correlated to global liquidity. It's also correlated to tech stocks. There's a lot of retail participation in it as well. I mean, it's been around for a while. I think, we'll see where it goes. I think, it has been adopted, but there is some reluctance and it's sort of unknown. And it might be more for, when we speak about family offices, maybe the future generations will adopt it more than the current generations, just because there might be a comfort there. So.
Okay.
If I put my compliance hat on, I'll leave it at we're not involved with crypto.
Okay.
I do have views, but I can't share them.
Okay, understood. It's a big hat, I'm sure, the compliance hat.
It's market.
Yeah. The sorry, I meant to ask too. Just getting back to risk. I've read some opinion that the lower volatility of private equity, for instance, is more about no mark to market reporting is latent, right? Perhaps some massaging or creative valuation going on. What do you think of that criticism or questioning of private equity? How would you respond to that?
I'll maybe offer an initial thought. I mean, we're aware of it. I think there's a degree of, I think some of it comes from lagging. And again, I should say it depends on the asset class, because I think, I think it was Chris was talking about private REITs, but so if you talk about equity, specifically equity, sometimes it depends on the portfolio. If it's a fund to fund, like you may have a fund that holds, a whole bunch of other different you're always reliant upon the inflow of information flowing up. And so if you're, in a fund of funds, you're spraying to a number of different GPs, and so you're reliant on that information coming. That just creates a time lag. So I get that. It's not like the next day, what was the closing price like? That's going to be hard to really deliver. I think where you can get some comfort, I think is I'm not saying it's perfect, but is like the having third-party external valuations, right? There's always a bit of usually you get the marks from the other GP if it's a fund of funds, so that's arm's length. But you also, there should be a third-party valuation agent, and I see some nods here. So that I can't say that's perfect, but at least it gives you the an attempt for an objective, independent valuation, which at the end of the day, it's private. So that's ultimately all you can, I think, aspire to. Where the rubber hits the road is obviously when the asset is sold. That's when you get the real, clearing price, right? But so I think that's what I'll offer on there. I realize the frustration with the delay. It's maybe an information delay, which we're sympathetic to, but I think it just provides a bit of context around it.
Okay.
Totally agree with Robin. I think, is it a valid criticism? Sure. But it's just part and parcel of investing in alternative assets. They're not marked the same as a public equity portfolio, nor should they be. So you shouldn't expect it to be. And what it comes down to, what we do get questions on, how valid are these marks that they're putting on things? And exactly as you say, Robin, if you have a third party evaluator, it takes most of that debate out of the question. Listen, this is not us sitting around throwing numbers out in the air. There's at least somebody who does this, who came up with a value, and it's as close as you can get.
Well, and listen, I've done investment banking or valuation. Like, listen, there's a way to value private companies, there's a way to value pre-IPO. Like, so like this is not a science, right? I mean, as much as we all aspire to have finance become a science, there's always, if you look at any of these decks, there's always a range, right? Even, and again, I know this is trite. Even go get a price on your house. Like, tell me what it is. The agent's going to tell you what the comps are in the market in your little area and all this and that. But if you had a number and then tariffs happen, like you all understand this. It's stale and it's path dependent on conditions, right? So it's just imperfect and imprecise as opposed to like a final, price as of 4 p.m. last night or something. So I get it, but I think people have to understand that degree of opaqueness when they go into this a bit, or laggings maybe on another point.
Yeah, mercifully, it's actually a problem that's fairly restricted to private equity. If you have a diversified portfolio of alts, there's going to be 60-70% of them that actually have very frequent marks. Like your hedge fund strategies, they're largely trading in public securities. They'll give you a frequent mark. Your public REITs are frequent. Your merger arb strategy is frequent. So, it's a problem, but, not a big one.
Yeah. To Chris's point, just when you're reporting to clients and if you're showing them volatility numbers, there has to be an asterisk there, and just be aware that it might not be truly reflective of the entire portfolio.
Right. Okay. Good. One final question. We only have a couple minutes left. The profusion, I guess, or the growth of retail private funds, both in equity and credit, is that a good thing or a bad thing or an indifferent thing from your perspective?
Well, I know retail's a bit different. I think we think it's a good thing. We believe it's a good thing, but I think with the proper guardrails and the proper structures. So, we have a few evergreen offerings that again have the same strategy, structure, team, DNA as our institutional class. So a lot of times they're parallel, whether it's borrowers or finance vehicles. I think the big thing is making sure people understand that, whether it's an advisor or the end client, and that's something you have to focus on. We already touched upon the liquidity, which again, if it's not family office retail, like real retail, that's more of a concern, obviously. So that becomes a bit of an elevated topic. And I think there's this, it's a two-minded approach to it, right? I mean, we have a structure, at least for RSP, right? Like a long-term compounding vehicle, right? Go invest for 40 years and then you do it when you're retired. But yet most of the things that the regulators ask us to put in there are redeemable on demand. So it exactly undercuts the long-term compounding kind of phenomenon that I think even the governments and the regulators suggest would would augment a retirement outcome, but so they're kind of at odds with each other. So I think we're always trying to thread that needle to make sure we can do that while still staying true to, you know, the core and the essence of the strategy with of course a unique nod to liquidity here. So I don't think it's easy, but I do think it's, I hear the word democratization a lot. I hear this, and I think people hear that, they think it's a good thing, but listen, it's not exactly democratic like Canada in 2025. It's, you know, because it's maybe, I don't know, the US in the 1700s. Not everyone had a vote, right? It's not everyone has the same suffrage. So I think if we can do that and broaden it, it's a little bit like, why should CPP be able to do this, but not, you know, Dan Riverso person, you know what I mean? So but again, it's got to be structured appropriately. So just some final
I
thoughts.
agree with that, Robin. My concern about the democratization of alternatives is that, you know, there's this eligible investor exemption you probably heard of.
Yeah.
You can be a relatively unsophisticated investor and invest in an alternative investment strategy for, I think the number is $30,000 or something. Investment advisors through the bank-owned channel don't even know what questions to ask when evaluating an alternative investment. It's too much to expect individual retail investors investing directly through their EMD or a discount channel. It's too much to expect them to be able to ask the right questions. I'm a bit concerned about these alternatives going too far down retail. It's a worry.
And to be clear, Chris, when I say, I'm not saying directory, I'm saying through it, at least with the intermediation of an advisor, for sure. So I'm with you on that point for sure.
Yeah.
Okay.
I would, sorry, just maybe one last point. I'd agree with my co-panelists. You have to review these structures, as Robin pointed out. A lot of them have liquidity buckets. The returns will be a bit lower than a traditional private equity fund, just on the private equity side. But to Chris's earlier point, you also have to look at the gating provisions as well. So you have to think about what might go wrong if you're an advisor reviewing these types of strategies for your clients.
Yeah, we talk ourselves out of business all the time around the office with people that say, "Oh, I want to buy the Sagard this," and I'm like, have you married? Have you bought, like, this is not for you. Like, do not, you know, you're not accredited anyway. So we even amongst friends and colleagues, we try to make sure it's ends up in the proper hands.
Right. Okay. You know, gentlemen, I'm going to have to leave it at that because we are officially over time. I'm probably getting screamed at by the producer here. I can't hear him though. So I just wanted to say thank you to Dale, Chris, Dan, Robin. That was a terrific conversation. I don't think we covered every corner of alternatives. I'd like to hear more about music royalties at some point, and I think we could probably do a whole hour again on the democratization of private investment, but we'll have to leave it there. Thank you to our audience for joining us. Thanks again, Dale, Chris, Dan, and Robin. Hope to speak to you again soon, and have a nice day.
That was great, Joe. Thank you.
Thank you very much, everybody.
Thanks, everybody.
Have a great day.
Thanks,
guys.
guys.